Okay, let's unpack this. Um, Usually when you're trying to diagnose a problem, right, there's this expectation of precision. It's like basic medicine. You break your arm, the x-ray shows that jagged white line, and the doctor just points at it, broken or not broken.
Right, it's binary. You either see it or you don't.
Exactly. It's a clean, binary reality. And we take comfort in that because, we like things to be visible. But then you step into the world of global finance and macroeconomics on a day like today, and suddenly that x-ray machine is just completely shattered.
Oh, absolutely shattered.
We're looking at a diagnostic landscape that is entirely murky. Like the fundamental rules of cause and effect in the global market seemingly just broke down today. Or, well, more accurately, they operated on this level of hidden structural plumbing that most of us never get to see.
Yeah, it's the absolute definition of diagnostic muddy waters. Welcome to today's deep dive, everyone. We are looking at a massive stack of intelligence from a single, truly extraordinary day. Tuesday, July 7, 2026.
A day that will definitely be in the textbooks.
Oh, without a doubt. The sources paint this picture of a global financial system experiencing a massive synchronized whiplash. I mean, we're looking at a day where an 1,800% profit surge for a tech giant actually triggered a localized market crash.
Which is insane to even say out loud.
Right, and where billions of dollars of guaranteed buying power drove a stock's price down rather than up. Not to mention central bankers getting completely derailed by kinetic military actions half a world away.
So the mission for this deep dive is to decode exactly why these events happen. We're going to figure out how AI infrastructure, robotic algorithmic trading, Middle Eastern conflict, and central bank drama are all violently colliding to shape the world you live in right now.
We really want to peel back those surface headlines, look at the actual gears turning underneath.
Exactly. But really quickly, before we get into the weeds, I do need to make an important note for you listening. Today's sources contain politically charged content. We are going to be discussing U.S. monetary policy, the Trump administration, and the really intense geopolitical conflict involving the U.S., Israel, and Iran.
Yeah, it's a lot of heavy stuff.
It is. And we are not endorsing any of the political viewpoints or actions mentioned. We are taking absolutely no sides here. We are just impartially reporting on the factual content provided in the source material, simply to help you understand the broader economic implications.
And that neutrality is just a crucial baseline for us today because the macroeconomic environment right now is deeply, inextricably entangled with these politics.
You literally can't separate them anymore.
You can't. You cannot analyze the price of a barrel of oil or, say, the yield on a 10-year treasury bond today without looking directly at the maritime dynamics in the Strait of Hormuz or the factional dynamics within the Federal Reserve.
The separation between geopolitics and finance is just gone.
Completely gone.
Which means we have to look at the entire board. So let's set the table. July 7, 2026, delivered this series of cascading shocks. And the first one started with this bizarre paradox in East Asia, the South Korean shockwave.
Right, let's get into the Samsung numbers because they are wild.
They are staggering. So Samsung Electronics released their Q2 2026 preliminary earnings guidance. By any historical metric, these numbers are unbelievable. They posted consolidated sales of about 171 trillion Korean won.
Massive.
And the operating profit was roughly 89.4 trillion won. So to put that in perspective for you, that is an 18 to 19-fold year-over-year profit increase. 1,800%.
Yeah, an 1,800% jump.
And when a company with the sheer gravitational pull of Samsung, a company that basically makes up more than a quarter of the entire South Korean KOSPI index, when they post an 1,800% profit increase, every textbook says you're about to see a massive rally.
A face-melting rally. But the market reaction was the exact opposite. It was a violent crash.
Wait, really? Just straight down?
Straight down. Samsung shares tumbled 6.92% on the day. SK Hynix, their chief domestic competitor in the memory space, fell 6.06%. And the KOSPI index as a whole plunged as much as 8.19% intraday.
Wow. Over 8% for the whole index.
Yeah, it got so severe it actually triggered a level 1 circuit breaker on the exchange, meaning all cash, futures, and options trading were suspended for 20 minutes just to stop the bleeding.
Just a total halt.
A total halt. And to give you a sense of the volatility we were living through, this was the 6th circuit breaker of 2026. The total trading curbs this year have already broken the record of 26, which was set during the absolute depths of the 2008 global financial crisis.
That is terrifying. So I want to dig into the mechanics here.
Yeah.
Why does an 1,800% profit surge cause a market to halt trading in a panic? Like, the phrase "sell the news" gets thrown around, but this wasn't just psychology, right? It wasn't just traders taking profits.
No, this was structural. What's fascinating here is that it comes down to the underlying commodity driving this entire cycle, which is memory chips. Specifically, DRAM, dynamic random access memory.
The lifeblood of the AI boom.
Exactly. You cannot build these massive data centers to train language models without mountains of memory. But the market is fundamentally forward-looking. Institutional investors weren't reacting to Q2 profits. They were reacting to what the underlying data implied about Q3 and Q4.
Okay, so what did the data imply?
While overall demand for AI infrastructure is still robust, the sequential price growth of DRAM is tapering. The sources note DRAM prices rose by 30% sequentially in the second quarter.
Which sounds fantastic in isolation. A 30% price hike is a dream.
Right, but the analyst consensus had targeted 40%.
They missed the whisper number.
They missed it. And the reason they missed it is the crux of this paradox. It comes down to LTAs, long-term agreements.
Okay, break that down for us.
So, as the AI memory market matures, chip makers and their massive enterprise clients, the hyperscalers like Amazon and Microsoft, are signing these LTAs to lock in pricing bands. The goal is to minimize volatility for everyone. If you're authorizing a $10 billion data center, you can't have chip prices fluctuating wildly on the spot market. You need cost certainty.
So you sign a multi-year contract with Samsung that dictates the maximum price you'll pay.
Exactly. But by capping that downside risk for the buyer, Samsung inherently caps its own near-term profit upside.
It's basically like signing a fixed-rate lease on a rental property right before the neighborhood gentrifies.
Oh, that's a perfect analogy. Yes.
Like you played it safe.
Yeah.
You know exactly what your rent income is going to be every month. It's stable. But if a new transit hub opened and property values triple overnight, you locked yourself out of the windfall. You traded exponential upside for boring predictability.
And that's exactly what happened. The market looked at Samsung's massive profit and realized, oh, they already signed the leases. The neighborhood gentrified, the exponential growth phase is over, and the structural ceiling has been hit.
So the big money just bailed.
Big time. This realization triggered a massive capital flight from foreign institutional investors. They net sold 3.36 trillion won, that's roughly 2.19 billion US dollars on the main market on Tuesday alone, extending a 13-day selling streak.
And who is buying it? Let me guess. Retail investors trying to catch the falling knife.
You got it. South Korean retail investors net purchased 3.51 trillion won, seeing the 1,800% headline and thinking it was a dip. But the sources note their cash reserves were already tapped out. Customer deposits at brokerages had fallen from 137 trillion won in June down to 118 trillion by early July.
So they just didn't have the firepower to absorb the institutional dumping.
They really didn't. And this is where the hidden plumbing turns a bad day into a systemic crash. The downward pressure wasn't just human beings selling. It was heavily amplified by algorithmic trading from single-stock leveraged ETFs.
Right. I was looking at the mechanics of these leveraged ETFs, and it's basically a mathematical trap. Like if you buy an ETF that promises 2 times the daily return of Samsung, and Samsung drops 5%, your ETF drops 10%.
Yep, the math is brutal.
But to maintain that exact 2-to-1 leverage ratio for the next trading day, the ETF's internal algorithms have to automatically rebalance. Because the underlying asset value shrank, the fund is suddenly over-leveraged, maybe sitting at 2.5 times instead of 2.
Exactly. So to get back to its legal mandate of 2 times, it's mathematically forced to blindly sell shares into a crashing market right before the closing bell.
It's an automatic, emotionless dumping of shares.
Completely divorced from the fundamental value of the company. On Tuesday, these single-stock leveraged products in South Korea fell 12 to 14%, and their combined trading volume exceeded 13.11 trillion won.
Wow. That's massive.
It made up more than a third of the total ETF transaction value on the entire exchange. It created a reflexive downward spiral. Initial selling lowered the price, which triggered algorithms to sell, which lowered the price more, which triggered more algorithms.
A self-fulfilling prophecy of liquidation.
Yes, and South Korea's deputy PM actually had to announce that regulators are looking into emergency measures to minimize this leverage-induced volatility.
And because finance is completely interconnected, this didn't stop in Korea, right? The realization that the AI hardware cycle might be hitting a ceiling dragged down Wall Street immediately.
Oh yeah, contagion is real.
The S&P 500 fell 0.4%, the Dow dipped 0.2%, and the Nasdaq sank 1.2%. The pain was super concentrated in semiconductors. AMD dropped 6.5%. Intel fell an astonishing 9.7% in a single session. But here's an incredibly revealing detail from the sources. Despite the indices being down, market breadth was actually positive.
That is so telling.
Right. More individual S&P stocks actually rose than fell.
Which tells us everything about the extreme levels of index concentration right now. The major U.S. indices are so dominated by a tiny handful of tech megacaps that if semis catch a cold, the whole index gets pneumonia, even if the other 490 companies are doing great.
It really makes you wonder, is this just about memory chips hitting a ceiling, or is the whole AI gold rush narrative running out of steam? We've been in this build infrastructure at all costs phase, but eventually the bill comes due, right?
The sources definitely point toward a sobering reality check. There's a deeply bearish note from Morgan Stanley warning of fading momentum in the semiconductor upcycle. But the most telling metric in the whole stack of intelligence is the LLM Token Expenditure Index.
Okay, the large language model token expenditure index. For people not tracking this, it's essentially the odometer on the AI engine.
Yeah.
It tracks how much enterprise clients, banks, logistics firms are actually paying to use these AI models in their daily operations.
Exactly. It measures actual real-world utility. Between December 2025 and May 2026, that index doubled. That was the adoption phase. But from its peak in May through early July, the index dropped a staggering 20%.
A 20% drop in actual utilization in just weeks. That's the sound of the music stopping. Corporations ran their pilot programs, looked at the compute bills, and realized the ROI isn't there yet.
It's the classic pivot from building the railroad to figuring out if anyone is buying train tickets. The market is transitioning to a show me the ROI phase, and when the broader market gets nervous about tech fundamentals, we see the mechanical plumbing distort valuations even further. Which brings us to SpaceX and what the sources call the passive investing trap.
This SpaceX situation is a terrifying case study in market mechanics, overwhelming basic math. So SpaceX, ticker SPCX, was fast-tracked into the NASDAQ 100 index on July 7, just 15 days after its record-breaking IPO on June 12, where they raised $75 billion at $135 a share.
The NASDAQ actually revised its own rules in May to drop the mandatory waiting period just to capture this whale of an IPO.
Right. And joining the NASDAQ 100 isn't just prestige. It triggers a massive, legally binding financial event. The moment a company is added, every passive index fund that tracks the NASDAQ 100 is legally mandated to buy shares to mirror the index weightings.
If we connect this to the bigger picture, this passive inclusion forced $4.3 billion in automatic buying from NASDAQ 100 funds, like the QQQ, plus another $3 billion from Russell index adjustments.
So over $7 billion in guaranteed blind demand hitting the market in a single day. The funds don't look at the valuation, they just buy. And yet, on inclusion day, despite this tidal wave of guaranteed buying, SpaceX stock fell 5.2% to close near $160.42. How does a stock drop when $7 billion is legally forced to buy it?
It comes down to index front-running. It's this dark art where active management preys on the rigid mandates of passive funds. Every hedge fund manager knew the ETFs had to buy SpaceX shares exactly at the close on July 6th, the day before official inclusion.
They're just massive, slow-moving targets on autopilot.
Precisely. So aggressive hedge funds buy up SpaceX shares in the weeks leading up to it, driving the price up. Then, right at the closing cross on July 6, when the passive funds are forced to buy at market price, the hedge funds dump their shares directly onto the ETFs, they lock in profits, and that selling pressure overwhelms the guaranteed buying, driving the price down on inclusion day.
It's essentially legally sanctioned scalping on a multi-billion-dollar scale. Think about a stadium concert, right? A 100,000-seat stadium. But SpaceX has this unique equity structure. The sources note only 4 to 5% of the company's equity is actually available to trade as public float. Elon Musk retains 49%, and early backers are locked up.
Right, the float is tiny.
So out of 100,000 seats, only 4,000 tickets are available to the public. Now imagine a massive corporation, the passive ETF, is legally mandated to buy 3,000 of those specific tickets at whatever price the market demands, exactly 5 minutes before the concert.
And the scalpers, the hedge funds, know this corporation has a blank check. They buy the 4,000 tickets early for $100 each. The corporation shows up, the scalpers offer them for $200. The corporation has to buy them. The scalpers cash out, and then the secondary market for the remaining 1,000 tickets immediately collapses because the one guaranteed buyer is gone.
That dynamic is exactly why SpaceX dropped 5.2%. But looking past the plumbing, let's look at the actual fundamental valuation. I can't fathom how Wall Street justifies this. The sources say SpaceX lost $4.28 billion in Q1 2026 alone.
a massive loss.
Up over 700% from the prior year. They generated $4.69 billion in revenue, but they traded a staggering 94 times trailing sales, not earnings, sales, a $2.11 trillion valuation. I hear underwriters calling them a hyperscaler, but it's a heavy industrial logistics company that builds physical rockets. How do they justify 94 times sales while bleeding $4 billion a quarter?
Well, the quiet period just ended, so analyst notes are out. Wedbush set an outperform rating with a $190 price target, and their entire rationale rests on artificial intelligence.
Which just feels like slapping AI on a rocket company to justify a multiple.
It revolves around Starlink and global data backhaul. Wedbush points to $27.8 billion in projected annual revenue linked to satellite-connected computing agreements with titans like Anthropic and Alphabet.
Okay, so the thesis is that Starlink isn't just rural internet. It's the space-based, low-latency nervous system for the AI industry, bypassing terrestrial fiber choke points.
That's the bullish thesis. Macquarie also initiated coverage with a $250 target, citing direct-to-cell wireless. The narrative is that the heavy CapEx phase is a sunk cost, and they'll transition to a highly profitable toll road utility. But as you said, 94 times sales requires absolute perfection. Any delay or failure, and that multiple compresses violently.
And this highlights a terrifying systemic risk. Year-to-date ETF inflows passed $1 trillion in June. If all this money is flowing blindly into passive vehicles and they're mandated to buy concentrated low-float megacaps like SpaceX regardless of price, are passive flows creating a mathematically guaranteed bubble?
That is the exact fear keeping regulators awake at night. When the passive autopilot controls the vast majority of capital, true price discovery breaks down. We stop asking, what is this company's intrinsic value? And start asking, what is its weighting in the NASDAQ 100? And as we saw in Korea, when momentum reverses, blind buying turns into blind forced selling.
So put yourself in an institutional portfolio manager's shoes. You see the AI hardware cycle hitting a ceiling. You see ETF-driven volatility in tech megacaps. You want off the roller coaster, where do you hide? According to our sources, we're seeing a massive rotation into the defensive predictability of healthcare and brick-and-mortar real estate.
It's a textbook risk-off rotation, but the premiums they're petting show how desperate they are for stable cash flows.
Let's look at biopharma. July 7, Vertex Pharmaceuticals agreed to buy Crinetics for $10 billion in cash at $85 a share. That's a 102.2% premium over Crinetics' previous close, 100% premium. You only pay that if you're desperate to change your own trajectory.
To understand why, you have to look at Vertex's structural position. They hold a monopoly in cystic fibrosis treatments, generating over $10 billion annually, but they've basically saturated their patient base. The market is plateauing.
So they need new revenue streams.
Right. They're facing a growth cliff. So they're taking their cash and buying into the high-margin market for rare endocrine disorders. They're buying a late-stage pipeline.
Yeah. The sources highlight two specific assets. First is Palsonify, a once-daily oral pill for acromegaly, a rare growth hormone disorder. It replaces painful monthly injections and already made $10 million in Q1. Second is Atimulment, in phase 3 trials for congenital adrenal hyperplasia, or CAH.
Transitioning a treatment from a painful clinical injection to a daily pill at home is a massive leap forward. It improves compliance and builds commercial loyalty. Vertex projects these could generate over $5 billion in peak annual sales and be accretive to operating income by 2029.
Meaning real profit by 2029. But still, 102.2% premium. That's like paying double the asking price for a house, waiving the inspection, and paying cash just because you're terrified of the neighborhood you currently live in. Are these safe havens actually safe?
The broader market is super skeptical. Vertex shares ticked down after the announcement, and Stifel analyst Paul Mattis issued a stark warning, calling the $10 billion valuation a bullish case outcome that ignores massive competitive headwinds.
Right, because Palsonify is entering an acromegaly market where entrenched giants like Novartis and Pfizer already dominate.
Exactly. They have armies of sales reps and leverage for insurance formularies, and Atimulment, if approved, has to compete directly with Neurocrine's new drug, Crinecity, which already set a high safety bar. Vertex is paying a 100% premium for the privilege of going into trench warfare against Novartis and Pfizer.
That doesn't sound like a relaxing safe haven. And we see similar defensive moves in real estate. The sources mention National Health Investors, NHI, sold a $560 million portfolio of 35 skilled nursing and senior housing facilities to National Healthcare Corp.
It reflects a broader trend across corporate REITs trying to optimize balance sheets to survive persistently high interest rates. They're shedding non-core assets to raise cash and pay down expensive debt. Capital wants tangible sectors, but the cost of entry is incredibly steep and operational risks are high.
Okay, so you rotate to healthcare or senior housing to defend against tech volatility. But there is one macroeconomic force defensive stocks can't protect you from: global inflation driven by kinetic geopolitical warfare. Let's talk about the fire in the Strait of Hormuz.
This is where clean economic models collide violently with physical reality.
On July 7th, 3 massive commercial tankers were struck by projectiles and explosive drones in the Strait of Hormuz within 24 hours. The Qatari-flagged LNG carrier Al Raqayat suffered an engine room fire from a direct strike near Oman. The Saudi supertanker Wadian was hit by a missile, and a third unidentified tanker was hit by a drone.
This raises an important question: why these specific ships, and why right now? It's about maritime geography. The Strait of Hormuz handles about 20% of global petroleum flows. These 3 attacks specifically targeted vessels navigating a southern transit route hugging the Omani coast. Shippers were using it to deliberately avoid the northern lanes controlled by Iran's IRGC.
Here's where it gets really interesting. Iran doesn't need to physically blockade the 21-mile-wide strait and invite a U.S. military response. They just need a kinetic nudge. By striking the Omani route, they're sending a message: the South is deadly. They want to force commercial shipping back north into their lanes so they can board ships, inspect cargo, and dictate the flow of energy.
It's a masterclass in asymmetric leverage. And the timing is tied to Iran's chaotic internal politics following Operation Epic Fury.
Let's give context there. Operation Epic Fury was the joint U.S.-Israeli military campaign from February to May 2026, which resulted in the death of Iran's supreme leader, Ayatollah Ali Khamenei.
Right. And his successor, Mojtaba Khamenei, is navigating a fractured regime. He authorized a controversial MOU with the U.S. for economic relief, but ultra-hardliners like the Paydari Front are pushing back aggressively. 60 members of the Assembly of Experts issued a stark warning against violating red lines with the West.
So Mojtaba is threading a needle, and amidst this chaos, they're reshuffling military commanders. Rear Admiral Ali Azmai just replaced Tangsiri as head of the IRGC Navy,
which is a massive red flag. The U.S. sanctioned Azmai in 2019 for provocative actions against commercial shipping. The IRGC derives massive power from smuggling oil under sanctions. If the most succeeds and sanctions lift, they lose their monopoly. They want to spike tensions to derail diplomacy.
Plus, the U.S. just revoked the license for certain Iranian oil sales, dashing hopes of normalized traffic. It's like a hostage negotiation where the global economy is the hostage. The strait is the jugular vein. Iran doesn't even need to sever it. Just holding a razor blade to it by proving they can hit ships in Omani waters raises insurance premiums and oil prices globally.
And we saw Brent crude immediately spike 3% to 74.16 a barrel. Plus, a Houthi official visited Tehran, potentially to secure funds from the U.S.-Iran MOU to expand this choke point strategy to the Bab el-Mandeb Strait in the Red Sea.
A nightmare dual choke point threat. And even though OPEC Plus is planning to increase production by 188,000 barrels a day in August, the geopolitical risk premium keeps a hard floor under oil prices.
America just won't let oil get cheap when war risk is this high.
And this directly bleeds into the price of gas, which dictates inflation, which lands squarely on the desk of the most powerful financial official in the world, the chairman's crucible. Let's talk about Kevin Warsh at the Federal Reserve.
If you wanted to design a macroeconomic nightmare for a new Fed chair, this is it. Caught between conflicting data and unprecedented political pressure.
So Warsh was sworn in on May 22 by Justice Clarence Thomas. He just gave a speech in Sintra, Portugal, fiercely defending Fed independence against Trump administration pressure for immediate rate cuts. He said flatly, "We're going to deliver price stability."
Channeling his inner Paul Volcker. Because the data he's looking at is textbook stagflation, stagnant growth plus high inflation.
Right, the dual mandate is breaking. May CPI hit a 3-year high of 4.2%, driven by that Middle East energy shock. But the June jobs report was a dismal 57,000 jobs, massively missing the 115,000 forecast. Plus, the trade deficit surged to $77.6 billion.
When prior months were revised downward by 74,000 jobs. The headline unemployment rate ticked down to 4.2%, but only because the labor force participation rate shrank. People are just giving up.
Warsh is trapped. Cut rates to revive jobs and inflation runs out of control. Hold rates high to crush inflation and push a fragile labor market into a deep recession.
And to make it worse, Warsh refuses to provide forward guidance.
Right, the death of the Powell put. The Fed used to spoon-feed the markets with heavy hints. Warsh wants to be purely data-dependent, meeting by meeting, so the bond markets are flying totally blind.
And in response, the 10-year Treasury yield violently climbed to 4.54% from pre-war levels of 3.97. Borrowing just got way more expensive.
Warsh formed 5 internal task forces to figure out this new reality, including one on AI's impact on labor productivity. He argues AI will eventually be a massive deflationary force.
The theory being AI software expands productivity with fewer human hours, lowering production costs.
In the long run, sure. But right now, the trillion-dollar data centers are eating massive amounts of energy and driving up physical costs for copper and cooling. Is the Fed ignoring short-term inflationary pain for a long-term tech dream?
That tension is tearing Wall Street apart. A lack of Fed clarity drove record trading volumes. TradeWeb reported $69.7 trillion in volume for June. Institutions frantically buying derivatives to hedge against uncertainty.
And internally, the Fed is a mess. Former Chair Powell is stubbornly staying on the board during a construction investigation, and Governor Lisa Cook is under a DOJ mortgage fraud investigation.
It's a highly politicized, distracted environment for Warsh to execute the most delicate soft landing in history.
Which brings us to the ultimate synthesis. Why does this Tuesday in July 2026 matter to you listening right now? Because it proves the compartments of the global economy are gone.
Everything is structural, everything is linked.
A drone strike off Oman hits a gas tanker, which spikes Brent crude, which drives up headline inflation on Kevin Warsh's desk, which keeps your mortgage rate at 7%, which forces real estate trusts to panic sell nursing homes, while simultaneously sending capital fleeing into passive index funds, which mathematically forces $4.3 billion to blindly buy a wildly unprofitable space company just because it was added to a list. The plumbing is connected, and the pressure is building.
Which leaves us with a final provocative thought that ties all this together: the illusion of passive safety.
Unpack that for us.
Millions of people invest their retirement savings in passive index funds because we've been told it's safe, immune to human error and emotion. But when passive algorithms in South Korea force massive liquidations of profitable companies to maintain leverage ratios, and index rules in New York force billions to blindly buy a company at 94 times sales just to match a spreadsheet, the machines have become the true source of volatility.
The autopilot is what's causing the turbulence.
Precisely. These systems have grown so massive that their mechanical weight creates artificial bubbles and flash crashes. The passive structure is distorting reality. If the autopilot is causing the dive just to satisfy a rule, is it time for investors to grab the manual controls again?
It's a terrifying thought, but essential. We started by talking about X-rays. We want the world to be clean, broken, or not broken. But the economy is a living ecosystem governed by hidden plumbing, geopolitical grudges, and the cold math of index funds. The X-ray machine is broken because the patient keeps mutating. Our job is to help you see past the surface headlines and understand the mechanics underneath. Thank you for joining us on this deep dive. Keep questioning the narrative, look for the plumbing, and we'll see you next time.